Good morning, everyone, and thank you for joining me today as we chat to Resolution Capital and Bridge Fund managers to tap into their extensive experience within the global real estate markets. Now, I hope you enjoyed the title of the webinar, Solid Foundations. As I stand here in our office building today, which is empty, it feels like everything's changed. And as I hope you'll appreciate that the building still exists, there's still a rental income that's being paid on the building. So what I'd like to try and cover today is some of the fundamental concepts to consider when investing in global real estate around the world, what the drivers of the asset class are through time and how that may be different in the current environment, how REITs can still be considered a good diversification tool alongside other asset classes in your existing portfolio. And also I hope to spend some time touching on the important environmental, social and governance factors within the real estate universe. So to help me do this, I'm going to begin by talking to Andrew Parsons, the CIO and one of the founding members of Resolution Capital. Resolution Capital is a Sydney-based investment boutique dedicated to investing in global real estate assets around the world. The firm was founded in 2004 as a group of colleagues from Lend-Lease founded the firm, and they've been managing global REIT strategies since 2006, demonstrating an incredible ability to consistently outperform the index. So much so, in fact, if you analyze the 108 rolling 5-year period since the inception of their global strategy, they've beaten the index in every single time period. So 100% of the time over 5 years, they've beaten the index, managing to produce an excess return of 2.5% per annum. Andrew Parsons has around 30 years experience. So I think you'll agree that we have a true expert in the global real estate markets. Important factors to consider as everybody's feeling the noise or the pressure from what's going on in the current environment. But what are the consistent factors to understand when you're investing in listed real estate around the world?
Good morning, Rob, and good morning, everyone. And thanks for the introduction. And in relation to the issues, as you point out, we don't think that the way we look at things should fundamentally change because of a pandemic. At the end of the day, what we're focused on is the things that we think are the most important to all investments. It's the quality of the cash flow. And so obviously the pandemic has had quite a significant impact on certain parts of the real estate market. But overall, we don't think that the fundamental need for well-located real estate that is relevant to today's economy and the economy going forward has fundamentally changed. So we look for really, as I say, the most amount of cash that's generated by the real estate for the least amount of risk. And the three key factors that we take into account, as I say, is the real estate in terms of its relevance to today's economy, where you have robust tenant demand and limited supply, so that you have some pricing power. We look at the balance sheets because, at the end of the day, that's typically what really makes people or loses people money permanently in real estate. Good real estate will come back given time, but if you've got too much debt, then you are forced to sell the asset at the wrong time or raise equity at a deeply discounted price, which impairs your capital. So we look very much at the balance sheet. We want an appropriate balance sheet for the cash flow, and then last but not least, again, in times like these, the quality of management becomes clearer to people. So, and it's something we'll touch upon perhaps in greater detail later when we go through the ESG issues that you referred to. So, we look for, as I say, the best quality real estate, robust balance sheets, and outstanding management capable of delivering, excess cash that the market is underappreciating.
Okay, thank you. And if we then drill down a bit further, what sources of information are you using to assess the factors you just described? And also, what are the key indicators and metrics that investors should be following or looking out for?
Sure. So, I mean, look, that's one of the more challenging issues for us is that we do a lot of proprietary research, desktop research, analysing a lot of the data that comes out around the world. And honestly, we do check it by going and visiting, inspecting the property, and so that's become obviously a little more challenging in the last 9 months, given the onset of COVID and restriction of movement. But we're all in the same bucket. We're all in the same boat, I should say. Bucket, maybe, yes. We're all in the same boat at the moment in terms of restriction of movement. So, there's no doubt that the emphasis comes back to the physical research, or the data, more importantly. And what we're encouraged by is that the data sets up a reasonable outlook for the sector. First of all, as you've highlighted, the great enemy of real estate per se is too much supply. If you're an existing building owner, you don't want more supply. In fact, you want the least amount of supply possible, so that, again, you're facing limited competition. But as the chart you've highlighted there on the left suggests, supply levels are at, even in the lead up to the pandemic, we're only moderate. Now, if we look at those two charts highlight supply both in nominal terms, which is the darker blue line, and then it's also proportionate supply, which is the amount of stock that's being added as a proportion of the total existing stock. So you can see that compared with past cycles, supply has not been excessive by any measure. And of course, due to COVID, some construction has been put on hold. And so what we still have is, by and large, occupancy levels remain fairly elevated, and we're seeing limited amounts of excessive supply. So that sets us up for a reasonably good situation in terms of, again, the rental outlook. The other really important thing that also is highlighted by this chart is that the balance sheets of the industry are actually in pretty good shape, much better shape than when we headed again into the GFC. So we've got a situation, despite continued low interest rates, despite moderate supply, the REIT industry, by and large, and there are some exceptions, and unfortunately for South African investors, some a little too close to home, there are broadly some exceptions, but by and large, most of the REITs learnt the lessons of past downturns, and that is to have a balance sheet that can get you through, being stress tested in another downturn, for whatever reason that would be. So what we've got is, again, we've got a good supply-demand picture at the real estate level, and for the REITs, they've got a fairly reasonable balance sheet, which means that many of the REITs are actually in very good shape to be able to actually take advantage of any distress that does come out of the current economic challenges.
Thank you. And if we look at that chart on the right, we see that obviously the dynamics of the real estate sector have changed a lot over time, and you can see that just from the average loan to value, and we've seen it kicked up in 2020 as well. Would you mind kind of giving us a brief history of what is an acceptable level? Has that changed over time? What are the good and bad things that company management have done to affect that measure? And what sort of conversations do you have with them to address any such issues that may arise?
There's no, look, it's a good question in terms, but there's no, this is the right level or the maximum level of leverage, because every real estate's all different. It's in different points of its cycle, different points of its cash flows. So, for example, if I can find, dare I say it, a US government lease on a building that goes out 30 years, then I'll put as much leverage on it as I possibly can, because there's very little chance of that property breaching its loan covenants, provided, of course, you can get the right debt. Now, why I say the right debt is in markets such as Australia, South Africa, and the UK, debt or leverage is often measured by the lenders as loan to value. So value does play an important part, but if the cash flow is not at risk, if you've got to say a 30-year, and I'm using an extreme here, but just to highlight the point that you can't generalize, but if I've got a 30-year lease to the US government, then I can have higher leverage because the chance of cash flow default is very low. But I do have to, in those markets, or in some markets, look at loan to value. Now, in the US, surprisingly, they do not typically have loan to value covenants. In other words, if you meet your interest payments, the banks, or the lender, I should say, the lender leaves you alone until the debt falls due. Now, that's all background to say it is about the quality of the cash flow, because there's some assets where I wouldn't want to have any leverage on if I was taking exposure to it, because frankly the cash flow is not strong enough to support debt. So that's at the other end of the extreme. What we've tended to find, we'd prefer to see leverage. We look at it debt to EBIT. That's the best way we look at it, because loan to value is subjective. But we look at debt to EBIT. We think that's the most objective way of looking at leverage, and we've tended to find vehicles at more than 8 times you've got to worry about. Not necessarily bad, but you do have to worry about. More than 10 times you really do need to keep on top of, because you have to understand the cash flow. And to give you an idea, you know, Hammerson, which is a stock that you guys would be familiar with, Into, another one, they had debt to EBIT of over 12 times. So you know, they given the quality of the cash flow, were quite vulnerable to any further deterioration. So in a long-winded way, we like debt to EBIT. We really like balance sheets less than 6 times, which equates to, in today's terms, about 30% loan to value. In simple terms, it's not to say we won't invest in stocks above that, but it has to have very favourable cash flow, very favourable debt terms in terms of debt maturities, and without restrictive covenants, such as very tight loan to values.
In this current environment, have you changed the way you're doing anything, or temporarily, or has it made you look differently about your investment process? And you touched on it earlier, but you're not able to kick the tires or go and walk around a mall in Japan, for example. So how are you managing that change?
It is more challenging. We are trying to look at measures like replacement cost more closely, and that's where we're starting to find things are getting interesting in certain segments of the real estate market, where we are seeing some outstanding value. I mean, we've obviously had a bias against retail for a number of years, but we're actually finding some retail which is now being valued at the equivalent of industrial space, and it's better located than most typical sheds. So that's when it gets pretty interesting to us. Now, I'm not saying that that's widespread, but there are some examples of that taking place. It is going to be challenging regardless for these retail platforms, even if they're in good locations, because a transition from retail to some other use, whether it's higher and better use such as residential or logistics industrial, it's not a smooth transition. So but that is a very important measure that we look at. We're buying at the moment US apartments that are now, you're factoring in very, very little premium to replacement cost. So, hotels in the US are trading now at massive discounts to replacement cost. The problem with the hotels is, of course, that they don't have cash flow. This is so much worse for hotels than the GFC, because even during the GFC, their earnings fell by circa 50 to 60%, but they were still generating some cash flow that was able to pay overheads and finance costs. The big risk was that they would have a debt maturity, which was obviously that was the problem in the GFC. It was the lack of credit availability. The problem for the hotels today is that they're actually generating operating cash losses, so they're not able to even cover their overheads, let alone their interest costs. So that's the great challenge when you're looking at a price to replacement cost. That's all well and good, but if you're generating cash flow losses, that's a huge problem for you, because you are going to fall into the trap or the risk of breaching on a number of covenants, interest cover, for example. So again, what we're trying to do is try and think 2 to 3 years out how things will look, and who's at most risk to breaching on covenants in the meantime, or running out of liquidity. Because it's all very good buying at big discounts, but if you're forced again to raise equity because you've got no liquidity, if you're forced to sell assets, then a discount to valuation is meaningless, because you're not going to be able to do better because you're going to be forced to sell assets or raise equity. Student housing is an interesting one, for those reasons. There is obviously concerns about the ability of the colleges to return. We've taken a position there because we had the view that, unlike some other parts of the market, that that the colleges would return. It was important for a number of different aspects, and therefore, when we looked at the replacement cost, trading it at or below replacement cost for cash flow, we thought would be reasonably durable. That to us was a pretty enticing dynamic. So we've taken some exposure to student housing, and to give you an idea of the dynamic, there was we've got an investment in a US REIT called American Campus Communities. Student accommodation in circa 80 markets in the US, or 80 colleges in the US. 6 of the colleges closed to all in-class learning, so no in-class learning, and yet their student accommodation had 80% occupancy, because young people just wanted to get away from home and they wanted to go and spend time with their peers and get, summarily drunk, I imagine, while they were studying in their dorms. So it does highlight to us, again, well-located real estate. If you've got the cash flow, it should be fine.
So you touched on a few of the sectors there, Andrew, but if I bring up this next slide, it gives a breakdown of all the subsectors. Now, what I don't think people really appreciate is how different some of these sectors act. And at times of stress, obviously, they're all lumped in together in terms of the global real estate sector. But would you just touch on some of the different dynamics of some of the underlying sectors, perhaps, that you have exposure to?
Sure. So fortunately, heading into the pandemic, we were reasonably well positioned in areas that were beneficiaries of the pandemic. But why we were there was that we could see long-term secular trends that supported them. And I'm talking about clearly data centers and cell towers and logistics. So e-commerce beneficiaries and the move towards digital trade and automation. So you've got the opportunity through global real estate to invest in meaningfully in some of the world's best platforms in that area. Residential. It's not just it's not simply apartments. It's a whole range of different types of residential property in multiple different markets. So we do have quite a significant investment in apartments in Germany. Now, German apartments, typically they're affordable housing, low rents for large swathes of the population, and so there is no alternative, right? And the government actually backstops a lot of the rent payments, so that particular market did extraordinarily well again during the GFC because the rents are so low, and again, people had few alternatives on where they could move to. Now, by contrast, you also had an exposure. You could have an exposure to New York residential, which obviously didn't do so well as people basically went from urban Manhattan, deurbanized to the suburbs, and to the Sunbelt markets of the US. So, within even apartments, different markets have different dynamics, but we fortunately had good exposure to German apartments in particular. Single family homes is a relatively new area that's come about out of the GFC when, of course, you had the subprime crisis led to a huge number of single family homes being put on the market. Those properties were dare I say it, hoovered up and consolidated into a couple of vehicles. We've got an investment in a stock called Invitation Homes. It owns 80,000 single family homes in the US, and it's been enjoying fantastic demand because of a shortage of residential homes to start with. And then, of course, during the pandemic, people wanted to isolate, which meant that they wanted to live in lower density style accommodation, which has benefited the single family home segment. Then, of course, as I said earlier, we also include student housing and also what's called MHCs, which are manufactured home communities, which are the equivalent of trailer parks. So enormous diversification in, basic needs, shelter, as well as the growth economy, the key parts of the economy being, as I say, digitisation and e-commerce. But you can also buy into healthcare. Now, healthcare is going to be obviously pretty interesting going forward the next couple of years because maybe governments have spent too little on healthcare. It's been a healthcare crisis, not necessarily just a disease crisis. It's been the overworking or too much pressure on the healthcare systems. And so the question is going to be how much money needs to be spent on effective healthcare facilities. And so that's an area that we think will be pretty interesting to watch over the next couple of years. And then you've got obviously your traditional areas of retail and office. I should also add meaningful exposures to the likes of self-storage as well. We've got a fantastic array of, as I say, relevant real estate, durable, that we think is going to demonstrate fantastic returns over the next 5, 10, 15, 20 years.
Thank you. And I had a few questions come through, but just quickly on something you mentioned there. There's office and there's office. And you touched earlier on you'd be happy to take on more debt in a business that has a long-term government exposure, but also there's the life science office parks as well that are needed even during this time. So would you mind describing the difference between traditional office or the building I'm standing in, for example, where you're based in Australia, relative to either government or life science?
Sure. So life science basically is research, lab space, mostly leased to therapeutic companies who undertake research into new drugs, for example. So obviously it's been used, the space has been used in the last 9 months for an enormous amount of work on developing a new drug vaccine for COVID-19. But the great thing about life science is that people think that it's research, it must be risky. But when you look at the companies that typically lease space, they're very large organizations. And the great thing is that their research programs are long dated. They have funding that is very long dated, because there's no point starting research into a cancer drug if you've only got 12 months of funding. So when they go out and they take space, it's with the idea that they're going to take 8 years, 10 years to see if they can develop a new drug for a new need. And so, in fact, the demand in that space has been incredibly resilient. Again, I highlight people here, lab space, life science research, and think that it's volatile. Well, as I say, it's actually been incredibly stable. And again, one of the other things that is we really like about that space is that the leases are what's called triple net, and that means that the tenant is responsible for all management of the property, basically all the expenses associated with managing the property, for a couple of reasons. They don't want outside contractors associated with the landlord coming in to fix things, because they don't understand the sensitive nature of the work, both in terms of for security reasons, but also because it is such a sterile environment for the research. So what happens is the tenant basically says, look, we'll just pay you a rent and we'll take care of the complete internals. And people continue to underestimate the leakage in real estate. Anybody who owns a home understands to properly maintain a home. And if you're trying to attract tenants, you've got to do that bit more than if you're living in your home. You can get by with a few frayed edges on the carpet, etc. for a while. If you're trying to lease a building, the carpet's got to be replaced. The walls have got to be repainted regularly. You've got to get the air conditioning fixed all the time. All these things that people don't take into account when they're looking at commercial property investment. It's leakage. The great thing with these triple net leases is, again, the tenant is responsible for all outgoings. So we literally, as the or the landlord, in this case Alexandria is the great example, they just collect a rent check, right? And without having to reinvest or repair the property during the period of the lease. Now, when the tenant leaves, obviously, yes, there will be some rectification works, but for the life of the lease, it's a pretty good pure cash flow.
Thank you, that's great. The question has come through is, and you touched on residential earlier, is single dwelling residential property ever a good idea, or only, as you mentioned, multiple dwelling units versus, I guess, housing estates that are built?
So, look, before we go on, maybe if you turn to slide 17, Rob, Alexandria, just very quickly so people can see what I'm talking about. So Alexandria is been a long-standing position in the portfolio, and it's been a fantastic performer. And you can see the types of real estate it owns. I mean, extraordinary cluster of properties right next to MIT in Cambridge. So that again, I think, highlights the types of real estate we're talking about. It's not some, property in the middle of nowhere. This is typically associated with major learning centres, major universities, major research areas of the US, and so it's been a very hard to replicate portfolio that's done extraordinarily well. Sorry, now back to the question about single family homes. So yes, there is a vehicle in the US in which we have an investment called Invitation Homes that owns 6,000 dwellings. These are single family homes. Now, there was some skepticism about the ability to manage the portfolio because, of course, if you own an apartment block, and typically in the US there might be 200, 300, 400 apartments, you have a full-time staff maintaining the property in a fairly efficient manner. When Invitation Homes was created, there was concerns, how do you maintain a property where the tradesmen have got to go maybe 2 miles, 3 miles, 4 miles between properties to get things fixed? What we're seeing is that they are driving efficiencies, and a lot of it is due to technology. So, for example, and even going back to the inspection. Now, today you turn up, there'll be a security code. The premises will have cameras. There's a security code. You're given a code. You're free to go in and look at the property without an agent standing over your shoulder, looking at their watch, waiting for you to get through your inspection and then hassling you're going to take it. So the person's able to turn up at the property, punch in a code, go in, take a look at the property, and then leave. So there's no pressure, and people feel more comfortable doing that. And then when they're there, we're seeing more and more of the standardization of products and also technology helping to monitor products before they break down, so you can send people out proactively. You can monitor things from a distance through central planning, central technology hubs that monitors the property. So, and then what they're going to start doing is adding more services. So, for example, you own the property, you're responsible for the upkeep of the property. But I tell you what, we'll do it for you. We'll do the gardening, for example, if you pay a fee. So they're looking at, we'll do insurance for you. So they're looking at adding more revenue generating services in order to enhance returns. So it's been, the residential apartment buildings have margins of net rent to gross rent of about 65 to 70%. The single family homes started off at about 55%. Net rent to gross rent, and they're now catching up. They're up to about 63, 64%. So surprisingly to many, the efficiency of managing a portfolio of properties has started to benefit the owners. So through sheer scale, right? And that is another feature that the REITs have, that they have the scale to have in place these technology, spend money on technology to drive cost benefits.
Thank you, Andrew. Just wanted to touch on one of the components of return, which was the income, and we've had a question on what kind of yields are you achieving on the portfolio. We included a slide here
I
at the
think it's
pack on
back
the
up.
rolling
Yeah.
3-year income return.
Mhm.
And so within that, would you just touch on how people should be using a global REIT portfolio within their broader investment set, and what they can expect in terms of income and capital growth, or have traditionally expected, maybe?
Sure. It's a very interesting dynamic at the moment. People have heard us speak before know that we do not make a big deal about income. We're a total return investor. We've seen, unfortunately, in my career over the years, too much fixation on yield, and it gets too many people into trouble. We think yield's an outcome. It's not something you should focus. Obviously, we want it to produce an income yield for our clients, but we're trying to find a total return that, yes, includes an income component, but we don't start backwards, starting from income and then working backwards. We really look at the quality of the real estate and its potential to generate pricing power, cash flow growth, and therefore its ability to spin off yield. Again, what we've seen over the years, too many people have tried to engineer things from income backwards, and unfortunately it just doesn't work that way. Good real estate, frankly, high yield is not necessarily a particularly good predictor. In fact, it's quite often a bad predictor of good returns, in the future. So you can see there, though, that the index supposedly around 4. I'd say there's some erosion, quite frankly, due to parts of the market like retail, hotels, which aren't huge parts of the market, but they're under some pressure. So there'll be some pressure on that. And again, we probably don't play in the higher yielding part of the market because again, we've found over the years that it's just been a problematic ultimately.
Thank you. And we're running out of time, I'm afraid, Andrew, but what I would like you to just touch on is the environmental, social and governance component of your investment approach. And would you just start by explaining what the GRESB is, or the Global Real Estate Sustainability Benchmark?
Sure. So GRESB is one of the better ways of measuring the environmental characteristics of the property. It is not a rating system. It's merely trying to help people measure. And believe me, we don't believe in greenwashing. If you're looking for, well, we have the lowest carbon footprint, it doesn't work that way. For us, you can actually invest in a REIT that actually has a very low environmental rating. But that might be actually a deliberate strategy, so that they go out and they buy properties that don't meet the criteria, but then retrofit, which is much more efficient or more environmentally sustainable to do than demolishing and starting a new building. So again, we don't believe in a number. It is all about looking at what the objective is. Ultimately, though, we believe that more sustainable buildings tend to have lower operating costs, and they're more attractive to more tenants, because more tenants are looking for a lower operating cost, number one, and number two, more tenants are looking for more sustainable buildings because of their own policies. So we think that it actually is just sensible, good investment protocol. It's not something that makes us feel good. We love the fact that we look at that issue, but to us, it actually makes investment sense. So that's our objective. But what we try to do when we look at GRESB and other measures, when we talk about ESG, it is all about engagement, right? It's not about a destination. We've got so much to learn and to change over the next, hopefully not long term, but for the good of the environment and the good of everybody's health. And we'll only do that through engagement. And so we constantly engage with our managers to see what they're doing and see where they can improve. And there's been some really interesting changes and that have taken place in the last couple of years, and there's some outstanding platforms that we think are really at the forefront, both in public and private markets, that again leads to us to better outcomes all round.
And we had a question come through.
Yeah, just in relation to corporate governance, I mean, environmental, social, corporate governance. Look, we've long been believers in corporate governance. We hate conflicts. The conflicts tend to go in favour of the management or whoever is in conflict, rather than us, the shareholder. So we've always believed in looking for the best possible alignment between management and ourselves, so that ultimately management is trying to derive the most amount of return from the asset base for the benefit of all shareholders. So again, corporate governance, in simple terms, we don't like conflict. Look, I think this classic one at the moment in South Africa is Investec Australia. When I saw the $40 million payment for the internalisation of management, I thought it was 40 million rand. So I think we'll leave that one there.
Thank you. I wasn't really going to ask about this because I don't know if it's a relevant consideration for you, but we had a question come through on how do you factor political risk into your cash flow analysis. Obviously very pertinent as we sit here today with what's going on and the sizable proportion of your portfolio that's in the US. So is it something that you have to take into account, and should we be worried about a new Trump government?
If I knew the answer to that, I wouldn't be a humble REIT manager. We've managed money for in global markets for 14 years. We used to get criticised. We didn't have an economics department, and that was prior to the GFC. Well, we did pretty well in the GFC. We just try and play a straight bat. We're just looking for, again, best quality cash flow, strong balance sheets, and aligned management, and the rest of it, that's just not our we're just, as I say, humble REIT investment managers.
Okay. Well, on that note, Andrew, I'm going to say thank you very much for your input. I found it incredibly interesting. And for all those listening, I would encourage you to please take a look at the Resolution Capital podcast channel. Andrew has been interviewing the CEOs of some of the global REIT businesses within the portfolio. There's some fantastic content and incredible insight into the subsectors of the global REIT universe. So have a look at that. I'll say goodbye to you there, Andrew, and thank you very much.
Thanks, guys.